IRS announces 2019 tax rates, standard deductions, and a whole lot more. So let's dive right into this because it's going to be important here in a month's time for you to start paying attention to. So welcome to the Heritage Wealth Planning YouTube channel, my friends, the place where we come taxes, retirement, strategies on investing, the whole thing. So don't forget to subscribe down below. And as always, if you like what you see here, thumbs up and tell your friends, and comments are appreciated. So this is going to be a quick one here. It's just an article. I've been sitting in my, as you can see, my tabs up here. There's lots of tabs, lots of open tabs of things I want to discuss. This is from Forbes from November 15th. Man, I've had this sitting there for 2 weeks. So this is from Kelly Phillips, and I'm not sure what I get. Oh, Herb. Kelly Phillips, Herb. I'm a big fan of Kelly, actually. I don't never met her, don't know her, never spoken to her, but I like what she writes, and I follow her all the time in Forbes. So this is from Forbes, and she says, the article I just said, IRS announces 2019 tax rates, deduction amounts, and more. So what are we looking at here? The IRS has announced the annual inflation adjustments for 60 tax provisions for the year 2019. There are a number these are the numbers for the 2019 year beginning January 1st, 2019. They're not the numbers and tables you'll use to prepare your taxes for 2018. So just be advised, you're still using the tax tables from 2018. These are for 2019 going forward. If you aren't expecting any significant changes in 2019, you can use the updated numbers to estimate your liability. If you plan to make more money or change your circumstances, i.e. get married, start a business, have a baby, consider adjusting your withholding, and that's your W-4, my friends. So if you're working for an employer and you have W-2 employee, i.e. you stamp the time clock and you get a paycheck, you're going to have a W-4 for how much you should withhold. So if you want to withhold more, withhold less, you want to increase, you want to change your W-4. To check the updated Irs Withholding Calculator, and we'll show you here, but there's a bunch of clicks. I'll just put the thing in the show notes that you can click on yourself. For more on how to adjust your withholding, use the updated Form W-4 that Kelly links to as well. The big news, of course, is the tax brackets and tax rates for 2019. There are still 7 tax rates. They are 10, 12, 22, 24, 32, 35, and 37. And there is also a 0 tax rate. And here's how those break out by filing tax status. $0 to $9,700 is your taxable income. And I think before, what did you have it before? I think it was 90. That's if you're single. Okay. So actually, let me see if I have it in my book here. I mean, I have it in my book. I always forget what page it's on, though. Hold on just a second. My daughter is upstairs banging away. Oh, my land. She's making a big noise up there if y'all can hear that. All right. So if you're a single, you're right here. So, yeah. Okay. So went from 9525 to 9,700 and the 10% tax bracket. And again, this is taxable income. This is after your standard deductions or if you itemize. 38,700 was the top threshold of the 12%. Now it's 39,475. So that's almost $1,000 increase. That's good. 82.5 was the top threshold of the 22 bracket before. Now it's 84.2, which is that's almost 2,000. So that's good stuff there. That's what I'm talking about. Oh, in fact, 510 is a top threshold before. It's just 500. So that's a 5% increase. So I'll take that. Married filing jointly, 19,400 is the threshold if you're married filing jointly, and before it was 19,050. So we've increased that by $350. All right. 78,950 is the upper limit of the 12%. Before 77,400, so 1,500 right there. So that's all good. So good increases in your taxable income in terms of how you stand in the 10 and the 12% bracket across the board. So I'm pleased to see that. Heads of a household, married filing separately. Trust and estates, that just real quick, my friends. If you have trusts, and this is a revocable living trust. These are just trusts that retain the income. It's an RLT, revocable or inter vivos trust. Any tax consequences flow back to the grantor. All right. So I open a trust account, a revocable living trust. I and my wife, Charlotte, are the co-trustees. If we make $1 million of income in that trust, it still flows back to me and Charlotte as our standard tax filing scenario. If it's an irrevocable trust or it's an estate and it makes income above and beyond the $12,750 threshold, that's taxed at the highest tax bracket there is at 37%. And that's retained, by the way. All right. So you retain the income in your trust. Yeah. I mean, we're talking 12,750 capital gains, dividends, the whole thing. If that in taxable interest, if that's retained in the trust or if it's retained in the estate, that's bad. So let me just give you an example. If you're the trustee of an irrevocable trust or you're settling an estate and there's big capital gain, dividends, interest, distributions, whatnot, and you don't send that money out of the trust, all right? So the trust retains the asset is above $12,000 of income. The trust is paying 37% tax on that, and I don't even know what the state would be. I just don't know. The state tax of Massachusetts. So you could be losing on, I mean, literally $15,000, almost a half of that, simply because you did not send that asset to somebody else. Distributable net income, DNI, is what they're talking about. If that isn't redistributed, if that's retained, and you're the trustee and you got a cranky beneficiary who says, I want to see how you're managing this trust. And then they say, hey, Uncle Joe, why did you retain that income where we lost 50% of that? Why didn't you send that to me as a beneficiary of the trust? Because we lost 50% due to taxes and I could have easily used that money. You're going to be in a world of hurt because he could easily sue you and he'll win for sure because you failed your duties as a fiduciary to your beneficiaries. That's what you do as a trustee. And because of that, you'll lose that every single time. Well, I don't say every time, but most likely, unless there's some extenuating circumstance why little Johnny can't get that money and the trust should keep it instead. So just keep that in mind. All right, you can compare all the numbers to the 2018 tables here. So that's pretty cool. Remember to pay attention to the progressive nature of the rates when you're making comparisons. Don't simply multiply your income by the top rate. Oh, man, that's right, Kelly. People do that all the time. It's a marginal tax rate, my friends. The first $20,000 if you're married filing jointly, this is taxable income, is taxed at 10. The next, $60,000 roughly is taxed at 12. So if you're making $100,000 of taxable income, first 20 is taxed at 10, next 60 is taxed at 12, the next 20 is taxed at 22. Standard deduction amount have gone up. So now instead of $12,000 per person, it's $12,200 per person. Married filing jointly is now $24,400. So that's good. So we have higher tax limits in terms of where the income tax brackets are and higher standard deductions. That's a win-win. For addition, the additional standard deduction for those 65 and above and who are blind looks like it stays at $1,300. Okay, yeah, it did. So it did not increase. So if you're 65 or older, it's still $1,300 above the $12,000 it was before. But if you have if you're a single, you actually get a break. So it goes from $13,600 to $13,650. So we'll take that. That's good. For the standard deduction amount for an individual who may be claimed as a dependent by another taxpayer cannot exceed $1,100 or the sum of $350 and the individual's earned income. So again, no personal exemptions at all. The alternative minimum tax has been adjusted significantly, which is fantastic. Here's what those numbers look like. The exemption amount, I'm not following that. So I have to dive into that in a different thing. Kiddie tax applies to unearned income for children under the age of 19 and college students under the age of 24. Unearned income is income from sources other than wages and salary, like dividends and interest. So if they got dividends, capital gains, and interest, that's unearned income. Taxable income attributable to unearned income will be taxed according to the tax brackets of trusts and estates. So if you got unearned income, i.e. your kid's got a big mutual fund account and it's paying $14,000, $15,000, $20,000 of capital gains, dividends, and interest, they'll be subject to the tax brackets of the trusts and estates, which is pretty high, 37% again. Changes in itemized deductions on Schedule A. The floor for medical and dental expenses rises to 10%. It was 7.5% in 2018, which means you can only deduct those expenses which exceed 10% of your AGI. Again, most of you all, the vast majority of you all are not going to do any deductions, so this will be not non-starter. But if you do deductions, like I do, itemized deductions, this will be a hit to you if that is an issue. It goes from 7.5% of your AGI to 10% if you are itemizing to begin with. If you're not itemizing to begin with, it does not matter. Deductions for state local taxes, assault, state and local taxes remain at $10,000. Home mortgage interest, you may only deduct interest on acquisition indebtedness. You cannot do it on the home equity lines anymore. Up to $300 or up to $750,000 for married. It doesn't say that; it just says up to $750,000. So if you have a home with a mortgage of $750,000 or less, you can deduct it. That's for sure. Again, as long as the deduction on that itemized deductions exceed your standard deduction. If it doesn't matter. Charitable donations, there's some stuff there. The percentage limit for charitable cash donations to public charities increased 60% from 50% and remain at 60% in 2019. They talk about casualty and theft losses. Job expenses and miscellaneous deductions subject to 2% for, let's see, they've been eliminated. Okay, so miscellaneous deductions, unreimbursed employee and tax preparation expenses have been eliminated. For high income taxpayers who itemize their deductions, there are no P's limitations after former Rep Don Pease used a cap or phase certain exemptions. That's been eliminated. So that's fantastic. I never liked that. Some additional tax credits and deductions were adjusted for 2019. The child tax credit has been expanded to $2,000 per qualifying child and is refundable up to $1,400, subject to phase outs, and the phase outs are pretty high. The bill also includes a temporary $500 non-refundable credit for other qualifying dependents. Phase-outs which are not indexed for inflation will begin with adjusted gross income of more than $400,000 for married, filing, and joint. So that's pretty good. So they're not adjusting those for inflation, but it takes a lot of income to get that to begin with. And they got more on the expanded child tax credit, which you probably should read. It's confusing. Like I said, my wife with the H&R Block stuff, man, it is confusing. Earned income tax credit, EITC. The maximum EITC amount is for 2019 is $65.57 for married, filing jointly who have 3 or more qualifying children. And phase outs apply. You just got to be careful that EITC, man. The IRS is on that like white on rice. So if you're not following the letter of the law, you might find yourself in a hole with them. Adoption credit looks like it increases to $1,408 from $1,381. Student loan interest deduction, like the adoption credit, there were rumors that that would go away. It was not. The maximum amount that you can deduct off interest paid on student loans is $2,500. Again, you got to be deducting. Can't take the standard deduction. Actually, is that above the line deduction? I think student loan interest. I think it might be above the line deduction. I can't remember. Phase out if you're married, filing jointly is only $140 though. So just keep that in the back of your mind. It's not as high as some of the other ones. I'm a big fan of the lifetime learning credit. Adjust gross income used by joint filers to determine the reduction is $116,000. So if you're married, filing jointly, making less than $116,000, you still can qualify for the lifetime learning credit. Medical savings accounts, they don't talk about HSAs. High deductible health plans is one that for participants who have self-only coverage in the MSA, deductible is not less than $23.50, but not more than $3,500. The maximum out-of-pocket expense amount is $46.50, and that's for a HDHP, high deductible health plan. The unpopular individual mandate has been eliminated. All right, so no more getting taxed or penalized if you don't have health insurance. Don't forget those changes affecting pass-throughs and business owners who file a Schedule C, including the new Section 199A deduction. That's in qualified business income. QBI is going to be huge. And then for gift and estate tax rates, check out this right there. So again, I highly suggest that most of you all aren't going to be dealing with gift and estate taxes. That's for sure. So I would say don't worry about checking that out, at least from the Fed perspective. But for QBI, qualified business income, and 199A, just if you're running a business, man, you need to be following that. That's a big, big deal. And I hate to say it, I highly suspect your accountant isn't going to be as knowledgeable as he or she should be, because no one really knows how this is going to work. But it's a big deal. All right. Hope that helps. I'll put the thing here to Forbes on the link to Forbes in the doobly-doo, as my man Jonathan Sullivan from Gray Steel Weight Room talks about it on his YouTube channel, Gray Steel Gray Steel weight training, I think. He calls it the doobly doo. I just called the show notes. But anyway, I'll put a link to that. And of course, subscribe, thumbs up, comments, always welcome. And we'll see you next time. Thanks, guys.